Today we're going to talk about Beyond Meat. You've probably heard of it in the news. It went up 1,000% in just a few days and it became a meme stock. It's kind of like GameStop and now it's back to $2. We're going to do a deep dive stock analysis in the company. I'm going to try the products myself and we're going to find out whether this is a massive opportunity to make money. So without any further ado, let's get started. So what is Beyond Meat? They are essentially making meat products based on plants. So it's not real meat, it's plant-based. So they use like soy or all kinds of plant proteins to make the meat, and then they sell it. And the idea is that it will taste similar to real meat. So I'm from the Netherlands and I went to the supermarket and you can see that it's $4.69 for 250 grams. And here you can see a normal burger, which is around €5, but it's a little bit bigger. So it's kind of the same price. So not much cheaper. So I wouldn't say that this is a cheap product. But when it comes to taste, I think it tastes pretty good. So they do have a real product. And if the management will go better in the future, I think they can turn around. So the biggest question is, why is Beyond Meat only $2? And it was like 150 before. Why is it so low? Well, if we look here at a quick financial overview, we can see the problems with this company, right? We can see that the financial strength is horrible. They have a lot of debt. They are not profitable. They don't make their net income is actually negative. Their growth rank is low, and they have a lot of competition from companies, not from public companies, but like from private companies that are also selling like plant-based meat. We can see that the debt is pretty high and the cash levels are depleting. So later we're going to find out how long this business is going to survive. So stay tuned. And we can see here that the revenue has also been dropping slightly. In short, this company is losing money. It's burning money fast. For each burger they sell, they lose money. And that's the biggest risk of this company. One of the reasons that the stock price went up a lot in the last few days and then it collapsed is because Beyond Meat announced that they were doing a deal with Walmart and they are distributing their products now in Walmart. So Beyond Meat, a leader in plant-based meat, today announced plans with Walmart to increase availability of select products at over 2,000 stores nationwide. This is great because if they can sell more products to more people, then the chances of becoming profitable in the future will be much higher. So we're now looking at the Walmart website and we can see that they are now listed on Walmart, which is great for visibility and for sales. Before we are going to invest in a speculative stock, we need to use this formula, the cash runway. The cash runway measures the implied amount of time that an early stage startup can continue operating at a loss before depleting its cash on hand. Or in this case, a losing company. Can this company turn around? Maybe. But how much buffer, how many months they have left before they die, basically? How much money are they burning? And with this formula, cash runway is the cash on hand divided by the burn rate. We can find out how much time they have left. But if this company has only like 1 month, I think I would just stay away from it. So let's find out how many months this company has left before they burn through all this cash. How much time do they have to turn around to become a profitable stock? We're going to use the cash runway calculator, which is basically the same formula. Cash runway in months is the cash on hand divided by the monthly net burn. And all values are nominated in millions. So first we need the total cash on hand. The total cash and short-term investments are on the balance sheet in the latest quarter. So let's go to this financials of here. I'm looking now at TradingView. You can also do it on Yahoo Finance. So we're now at statements. We are going to the balance sheet and we're going to the latest quarter for this. And we're going to go to assets, total current assets, and here cash and short-term investments. So the latest quarter is 104.67. So we can just 104.67. Let's put 105. And now we are going to fill in the net burn. So that's the negative cash flow from operations. We're going to use the cash flow from operations, and that's in the cash flow statement. So we're going to do the here cash flow statement, and we are going to do cash from operating activities, and we're going to go to annual, and we're using the TTM, which is the last 12 months. And we can see that this number is negative because it's burning the cash, right? It's losing cash. So it's minus 110. We're going to put 110 in. And the period length is, because it's in the last 12 months, is 12. So we put 12. So we can see here that your cash runway is 11.5 months. They can survive for 11.5 months, so roughly a year, before they go bankrupt. Which means that this is a moderate cash position, so we need to monitor closely, but it's fine. Like we don't it's not going to go bankrupt next week, which is great. Before you get too excited and start buying Beyond Meat, let's show you like a portfolio example of how I invest. And you can see that what I do, this is just an example, but this is kind of what a good portfolio will look like, that is strong in all times. And you can see that you always need to have like a cash reserve. You can have like an S&P 500 position, and you have like companies with great economic moats like Google, Amazon, Nvidia, Tesla, Salesforce. So if you want to buy Beyond Meat, which is a losing company and it's a meme stock, you should not. You should only risk a small percentage. So for example, I would not go more than 2% of my portfolio into Beyond Meat. So let's say Beyond Meat goes to 0. My portfolio will drop by 2%. But if Beyond Meat goes to $50 or it goes crazy, it goes 10, 20x, this can make like 20%. Like if it goes times 10, for example, my portfolio will increase 10%, which is great. I think these kind of meme stocks where there is also a lot of people, psychology behind it, it's fun to participate, and I think it can also be a positive expectancy because you're risking very small to make a lot. Okay, so now we're looking at the charts of Beyond Meat. So recently, the stock price went up like 1,000% and then it dropped back to $2. This happens because of a short squeeze. Beyond Meat is one of the most shorted stocks at the moment, and the good news triggered losses of the short sellers, and they had to buy back, and that creates a feedback loop that the price even goes higher. So this can happen again, and if because of this short interest and there's just a little bit of good news, and now there are a lot of people who are buying that as a joke because it's like a meme stock, and this can push the prices even higher. And if it goes to the moon like this, then of course you have to take profits because it's not sustainable. But this is a way for speculative traders and investors to make money. We can see that it went here IPO at around $45. And now it's $2. The first time it went under $1. If a stock stays under $1 for more than 180 days, then the stock can get delisted from the Nasdaq exchange, and then it will continue to trade over the counter. I start buying at $1 and I bought more at $3. So my average cost is around 2 now. And I'm thinking about taking profits. The first time I will take profit is like $7. I will take a little bit, just a little bit. Then when it makes like a double top, I will at 8, something like here, I will take more profits. Here is the last time I take profits at like $48. $25 I can take. And one more, like 35 or something in the middle. I have a few hundred shares, and every time it hit one, I will take a little bit off, just a little bit. And after 48, I just have like maybe 50 shares left or something. That's my game plan. Of course, always do your own due diligence. I personally don't risk more than 2% of my portfolio. Yeah, know that this is a risky company, but I think if you mitigate the risk by only allocating a small percentage, you can still have a positive risk reward. Like then it now becomes like a small risk and high reward, and that's what we're all looking for as investors. I hope you learned something. Always do your own diligence, like and subscribe, and I'll see you in the next video.